Let's talk about the special issues in corporate ownership. Well, in recent years, several issues have grown in importance in the areas of corporate ownership, including joint ventures and strategic alliances, employees' stock ownership plans, and institutional ownership. Other important issues in the contemporary corporate ownership involve mergers, acquisitions, uh, divestitures, and spin offs. While joint ventures and strategic alliance are very important, in strategic alliances, two or more organizations collaborate on a project for mutual gain. When partners share ownership of what is essentially new as an enterprise, it is called a joint venture. The number of strategic alliances has increased rapidly in recent years on a domestic and international fronts. Employee stock ownership plans. An employee stock ownership plan ESOP allows employees to own a significant share of the corporation through a trust established on their own behalf. While current estimates count about 10,000 ESOPs in the United States. The growth rate in new ESOPs has allowed a bit in the recent years, but they still are an important part of the corporate ownership patterns in the United States. Institutional ownership. Most individual investors don't own enough of the stocks to exert influence on the corporate managers. In recent years, however, more stock resources have been bought by these investors, especially mutual and pension funds, and they could buy and hire blocks of stock. The National Teachers Retirement System (TIAA) and CREF have assets over $255 billion. Much of it has been invested in stocks, institutional investments, and they own almost 40% of all the stocks issued by the United States. Mergers, acquisitions, and divestitures and spin-off. Another important set of issues include mergers, acquisition, divestitures, and spin-off. Mergers and acquisitions involve the legal joining of two or more corporations, and a divestiture occurs when a corporation sells a business operation to another corporation. With a spin-off, it creates new corporation. Mergers and acquisitions. A merger occurs when two firms combine to create a new company. In acquisition, one firm buys another outright. Many deals that are loosely bound, called mergers, and really a real acquisition. Why? Because one of the firms will usually control the newly combined ownership. In general, when two firms are roughly the same size, the combination is usually called a merger. Even if one firm is taking control of the other, when the acquisition of the firm subsequently takes place and the larger one acquires the firm, the deal is really an acquisition. So-called M&As are an important form of the corporate strategy. They let firms increase product lines, expand corporations, go international, and create new enterprise. Then there are divestitures and spin-off. Sometimes a corporation decides to sell a part of its assets. There may be several reasons for such a step. A firm might decide, for an example, that it should focus more specifically on its core businesses. Thus, it will sell off unrelated or underperformed businesses, such as sales is called a divestiture. When a firm sells part of itself to raise capital, the strategy is known as a spin-off. A spin-off may also mean that a firm deems a business unit more valuable as a separate company. The Limited, for example, spun off three of its validities: Victoria's Secret, Bath and Body Works, White Band Candle. These are some of the companies who went for a spin-off, and by the spin-off they generated funds for themselves got the greatest of the investment for themselves, and this is how they made something for themselves, and they concentrated more on their core business, and something that they consider irrelevant and not very specifically for the business being profitable. They sell it away, and then whatever the sums of the investment they gain by it, they invest it on their own core business. It is one of the strategies, and it may be applied if the business requires it.